Hey guys, and welcome to the second video in the educational thread series. So in this series, I'm just going through my educational thread, which I've built up one by one. And the second one in this case is risk management. So if you've not seen the last one, check it out. It was about profit taking during a cycle. And yeah, let's get right into it. So first off, I'm doing everything in TradingView as a real trader would do. And the most important thing throughout this video is to understand that there's really no best way to apply risk management or to do it, but it's important that you do it because in the long run, it just helps you with consistency and also helps you against just blowing up your entire account during the inevitable downswings, which will happen. But in the end, these are just some guidelines and you should figure out for yourself what works and what doesn't. So there are a few steps that are very important to go through in my opinion to really get the basics down, which are defining the portfolio size which you're going to trade with, defining your risk appetite, so how much risk you're willing to take per trade, what your main trading style is, so is it scalping, is it swing trading, and how do you determine your position sizing, because people are always asking like, oh, how much leverage do you use, all that kind of stuff, but in the end it doesn't matter at all. It's all about your position sizing, and yeah, we're gonna go through all of these points one by one. So first off, defining the portfolio size which you're willing to trade with. What I would always recommend, especially if you're starting off, is not doing like more than 5% of your entire portfolio or crypto portfolio in this case, which you set aside for trading. I think it's really important to split these up because when you're just gonna trade with your entire spot portfolio and you're gonna trade in and out and in and out, eventually you're gonna get some kind of losing streak or whatever, and you're gonna be way too emotionally attached because it's just too much. And also, if you really screw up, then you're gonna have a hit on your entire portfolio. Well, if you only take like a small percentage, especially when starting off of your portfolio, even if you screw up or whatever, even if you screw up, then you're still not gonna be losing a lot of your portfolio. So what's the nice thing there is that you have a lot of room for error, and that even if something goes wrong, you'll still have your spot. And especially during a bull run, like let's say you trade with 5% of your trading portfolio and somehow you screw up and you lose everything. Well, during a bull run, hopefully your portfolio will go up. So this 95% of the rest will easily just compensate for the losses you make trading, and then throughout the cycle you'll still make money and not screw up everything by losing it trading. And then as time goes on and you're getting more confident and your trading goes better, you can of course just go to like a 90%, 10% split, 80-20, something like that. I think the main thing I've used throughout the years is like 80-20 for me. But just figure out what works and also what your risk appetite is, all that kind of stuff. But I would recommend to always start off small, and that way you can just slowly get into it and then learn that way. Then on to the second point, defining your risk appetite. So what this means is basically how much risk are you willing to take? Well, obviously people tend to like taking risks, especially in this market. But the main guidelines or recommended percentages per trade are approximately like a half to 2% per trade. So let's take 1% in this case, for example. Let's say you're trading with $1,000. That means that you're only taking 1% risk per trade. So that would equal to 1,000 divided by 100 makes $10. So that means the maximum you're willing or you're able to lose on one specific trade is $10 in that case, which is 1%. But always keep in mind, let's say you're opening like 5 longs on 5 different alts, for example. Obviously, those are mostly correlated and they're going to move together. So they're either all going to succeed or they're all going to fail. So in that case, realistically, you're taking like 5% risk already. So keep that in mind when taking on multiple positions, and also have guidelines for that for yourself. So let's say you take 1% of risk per trade, but then your maximum is like 2 or 3 trades at the same time towards the same direction. because otherwise the percentage doesn't really matter if you're opening up like 20 trades at the same time, for example. And obviously, if you're on like a hot or a cold streak, both can really work against you, because if you're doing really great, you're gonna think like, okay, everything is working, I'm just gonna keep upsizing my risk, all that kind of stuff, and then at some point you're gonna be hit with a loss streak, and then you'll give it all back. So be careful with that. But generally, I would say, let's say you're doing really well and you're really feeding the market, then it's okay to take a bit more risk, but obviously be ready to like scale down again if it goes wrong. And especially when you are on a cold streak, I'd say don't be too afraid and entirely stop trading. Also, don't be in the state where you're trying to make everything back and start revenge trading, because that's the worst thing, I think. But yeah, if you're not doing too great, and maybe just down your risk a bit, and then still take a trade here and there, and when you take some wins, then from there on out you can just start scaling back up again and go from there. Next up, determining your main trading style. So throughout the years, you'll find out what works for you and what you're best at. For me personally, I do like scalping a lot, and I go through these phases where I do it a lot and then I completely stop it, and it really depends. But the nice thing about scalping is obviously you're getting a lot of action, and you take all these short-term trades, and can be like several trades within hours, for example. But the downside is it takes like a lot of energy and time, and you're gonna go on these huge winning and losing streaks while doing so. So especially when starting off, I'd say just swing trading, have like a wider stop, wider target, and just try to catch like these several week or month moves in between. Obviously, that's going to be hard when the market goes sideways for like half a year, which tends to happen sometimes. But if you can somehow catch like the bottom of such a range and then just ride it for a few weeks on an alt or on Bitcoin, or for example, then those are generally going to be the easiest to manage, least stressful, and most recommendable, I think, for most people. So obviously also, depending on what trading style you take, is also important how much risk you're willing to take. Because a swing trade, maybe you're only doing like one trade a month, for example, at most. Then obviously it can be okay to risk like a bit higher percentage of your trading portfolio on that, because it's probably going to be like a lot higher conviction, higher probability that it's going to succeed in your opinion. So it makes sense to then take a bit more risk compared to, for example, a scalp trade where your invalidation is like 1% away from your entry, and those trades tend to go by like within hours or much quicker even. So in that case, I would do like very little risk each trade compared to your swing trades. So it's also something to keep in mind. And then the fourth point, which is much easier than people think, but something where everyone goes wrong. Once we determined all these things, how are we gonna determine how big our size should be? Well, we're just gonna go through the chart. And let's say, just going back in hindsight a bit, we want to short here because this is the 4-hour 200 EMA and MA, and we're seeing Bitcoin rejecting and rejecting here. Well, so we want to short here. And let's say we don't think Bitcoin is gonna go above this point. So we know our stop is gonna be somewhere around here. And we're targeting this range low here. So let's say this point. So that way we know our entry, because let's say we're trading here. So we know our entry, where we want to place our stop loss, and what our target will be. So how to determine how big our position should be? Well, there's these very neat tools built into TradingView, these long and short positions, which you can find here on the toolbar. And I got them favorited, so I got them in my work station up here. So in this case, we take the short tool, we click it up here. Then this middle part is where we are doing our entry. Well, in this case, it's up here. Then our stop loss will be somewhere above this high, because we don't want to see it go higher than here. That's our invalidation. and then our target is down here. So the first things we're seeing here is that our stop loss is 3% away from our entry. Our target is 7% away from our entry, which makes a total risk-reward ratio of 2.3 almost. So that means, in this case, that for every trade that we win, in this case, it will be 2.3 times as big as our losses. So if you also compare that to the probability that you need for this to be a profitable trade in the long run, let's say this works out 50% of the time. Well, in that case, 50% of the time you're gonna lose, in this case, let's say you're $10. But the other 50% of the time you're gonna make 23. So that's like more than 2 times as much. So that means in this case, you'll almost be, or you basically be break even if you only win like a third of the times. So that's kind of how you have to go through these trades. So in this case, let's say you think the chances is 50-50, then I would always take this trade, because in the long run, if you win 50% and lose 50% of these trades, it's gonna equal out to like a huge profit, because your wins are like more than 2 times as big as your losses. So that's really how you have to go through all these trades, and then in the long run, these will just stack up and really compound nicely. And then the last thing with this tool, if you go to the settings, this is exactly where you can also fill in your account size. So in this case, we have $1,000, then the risk we are willing to take. So let's, for this example, take 2%. And then this is all things you can determine by just sliding the points, which is easier than filling it out, I think. So in this case, $1,000, we take 2% risk per trade. So then what it says here, it's a bit low of an amount because we're trading in Bitcoin in this case, but this means your account size or your position size should be 0.015 Bitcoin. And then when I calculate it quickly on my calculator, that says 0.015 times whatever this is, 43.3K. That means our position size is like $650 in this case. So if we would do $650 times this 3.12% or whatever, it should come out to like $20, because once again, our account size is $1,000. We take 2% risk per trade. So our maximum loss when hitting the stop loss should be $20. And indeed, if we do the calculation, it comes out to be $20. So in this case, it's just very easy. As long as you just predetermine your entry, your stop loss, and your target, you can measure out your risk reward, the probability you need to get to make this a profitable trade in the long run, and also your exact position size you should be taking to really have managed your risk and know exactly how much you are gonna potentially lose at max and also win when this trade ends in one way or another. So that's basically the basics. Then lastly, something important to add to this point is journaling. I think this is something that's overlooked by many as well, and it really doesn't matter how you do it, whether you use pen and paper, Google spreadsheets, journaling tools can be very useful, but might be a bit pricey if you're just starting off. In my opinion, just use like Google spreadsheets, just mark everything down, and then after like a week of trading or maybe one specific trade, just go back, look back on it and how you did, and from there on out you can really learn from your mistakes. And then lastly, what to journal. Obviously, I'll get some guidelines for you guys which might be interesting. In this case, the main things I would track or I would write down are the specifics of the trade. So like the ticker you're trading, how your entry, target, stop loss was, and your results. So did it end up being a win? Was it a good win? Was it a break-even trade? All that kind of stuff. Also, very important in my opinion is your emotions before, during, and after the trade. Let's say you're on like a huge loss streak and you're taking this trade simply because you're trying to win it back. At the time, you might not have the discipline to actually not take the trade, recognizing you're not in a good mental state. But even if you take it, you can at least write it down. And then likely, I'm assuming if you have like a lot of a bigger sample size and a lot of these trades, and you see like every time you're taking these emotional trades, they're ending up in a loss, then obviously it can be very telling and shows you where you're making these mistakes. Obviously, also write down the type of trade. I mean, you could kind of figure that out from like your entry and target, that kind of stuff. But still, whether it was a scalp or a swing trade, all that kind of stuff, it can also really help you to figure out your preferred trading style and where you do best at. Also, the reason for entry. So, like, what was the reason you took the entry? Was it like a news trade? Was it because the chart broke out of the falling wedge? Was it because the chart broke down of head and shoulders or something like that, you know? Because everyone has these different mechanics or their trading methods where they're, or of how they determine their entries and their exits, all that kind of stuff. And especially also just your emotional state when taking that point and how you're thinking it's gonna play out. Just write down as much as you can, because if you keep doing that consistently, in the long run, it can be really beneficial to look back on and really see, okay, I think what I'm doing here is good, but somehow this trade is always failing. Like, let's say I'm entering all these breakouts of these falling wedges, but somehow I only win like 10% of the trades, and overall they're very unprofitable. Then you can really see in hindsight, okay, maybe I should either just stop doing this entirely or kind of play around with my entries and just figure it out through that way. And of course, like I wrote down anything else here, anything that might be important to you during your trading. So emotions, what happened during the trade, if you maybe cut the trade too soon and then it still ran afterwards, something like that. People just tend to always make the same mistakes, and even after years and years of trading, they're still doing the same mistakes. But just having like this noted down and eventually have like a big sample size of all these things you're doing can really be very educational, especially when you go back to study the trades, which is of course the last thing you should be doing. Once you have all this info on your own trades, going back and looking back at it is like the main thing you're gonna learn from, and this can really speed up your progress while trading. All right, guys, that was it. I really hope you enjoyed. And I'd say definitely start off with at least doing this, because just having your risk managed and your position sizes solid is already a huge help, and will help you against blowing up your account, all that stuff, because it's just where most people go wrong, especially when starting off, because you're just opening some random size and you're like, okay, this should be okay, and then it ends up being a huge loss, or you don't have your stop loss set, something in that way. Yeah, I mean, everyone goes through that, and it's a good lesson also mentally. But preferably, you're gonna want to be ahead of that and don't make the same mistakes. But of course, any mistake can be learned from, and everyone goes through that process. All right, I hope you guys enjoyed, and I wish you all a good day and good luck out there trading. Bye bye.